Our next reconciliation we will look at is Creditors Reconciliation. So the same way that we do bank reconciliation, we can also do reconciliation from an external source such as the creditor's statement, reconciling it with our own creditor's ledger accounts. So the business opens a separate account for every creditor in the creditor's ledger. All transactions regarding creditors are recorded in the subsidiary journals and are posted to the personal accounts of the creditors on the date of the transaction, in order to calculate the amount that the business owes to the creditor at the end of the month, according to the records of the business. Remember that a creditor is a liability to the business, which means increases are shown on the credit side and decreases are shown on the debit side of the creditor's account. So if I look at a specific creditor's ledger account, you can look at the example here. Debit will mean it's decreases, so those are for all of your payments, your discounts or returns or allowances. Credit, however, is the increasing side. So that is when I purchase more on credit, or when my checks are cancelled, so due to RD checks, or when interest is charged. And then the balance column is simply a balance. So it will always show a credit balance, and that is what we owe to the creditor according to the records of the business. So the creditor will create a separate personal account for the business in their debtors ledger, because for them, we are a debtor, where they will record all transactions that took place between them and the business in order to calculate the amount that the business owes them according to their own bookkeeping process. So at the end of the month, the business will receive a statement from the creditor. This statement is the account shown for the business in their debtors ledger of the creditor. So in other words, it will reflect all credit transactions concerning the business of which the creditor is aware of. So it is important to understand that the business is seen as a debtor, and then therefore it is an asset in the creditor's books. So all the payments or returns made by the business will decrease, but this will do it on the credit side, and then an increase will be on the debit side. So should the business buy more on credit, or a check has been dishonored, or the creditor has charged interest, it will result in the business owing more to the creditor, and then this amount will be debited to the statement received. Let's look at a typical statement in terms of the debtor's ledger. So you can see here the debit side shows increases, so that's when we purchased more from them, or when checks are cancelled, or when interest is charged. They will then go and decrease our account for all payments, all discounts, or any returns or allowances from their side. And then their balance would be actually a debit balance in their books, which means that we owe them. In other words, the business owes the creditor. So every month it will happen that there will be some transactions that the business entered into the business's books and that has already been recorded in the creditor's ledger. But it can also be that the creditor is unaware of some of the transactions, such as checks issued as payment but not yet received and recorded by the creditor, or returns made but not yet received or authorized by the creditor. There can also be transactions concerning the business which appears on the statement but which has not yet been recorded by the business in their creditor's ledger. For instance, interest charged by the creditor. So, or others is an increase or a decrease of which the business was not aware. It can further be the case that the creditor made some mistakes on the statement. For instance, an invoice was issued to another company but was wrongly added to the statement of the business, or discount was omitted by mistake. In short, at the end of the month, the balance of the personal account of the creditor in the creditor's ledger of the business will differ from the statement received from the creditor, because the transactions that have not been recorded in the records of both parties, or because of errors made by one of the parties. So in other words, there is a need for us to reconcile our books to that of the creditor. So the creditor's books needs to be reconciled with our creditor's ledger, and we do that by looking at the statement that they send to us. Let's look at the creditor's reconciliation process. At the end of every month, the reasons for the differences between the balances of the personal account of the creditor in the creditor's ledger and the balance of the statement must be sought, and entries must be made to rectify or to explain the reasons for the differences. Now, if the statement shows any amounts with which the creditor has already increased or decreased the account of the business, but which the business only sees when receiving the account statement, these entries, these increases or decreases, must merely be made in the personal account of the creditor, in the creditor's ledger. So it's the same as when the bank had entries on the bank statement, but we didn't yet have it in our books, then we had to just add it to our books. The same happens here. The creditor has some entries on the creditor's statement, but we don't know about that yet. Then we simply go and add it to our records, so that then our records and their records shows the same entries. So this will be added into the subsidiary journals of the business, so the transactions are reflected in our financial records and therefore in both parties' financial records. Should it, however, appear that from the statement that the business has made a wrong entry or an error in one of the subsidiary journals, for example, an amount was recorded as more or as less than the actual amount, this error can be corrected by making an entry in the general journal in order to correct the mistake. So again, the error was made in our books. We are in full control of our records, therefore we can simply go and correct the error in our records without any problem. So from the above, it should be clear that the business can, for these increases or decreases or the rectifying of errors, immediately make entries in their records in order to calculate the correct balance of the creditor's account. Because of the fact, however, that creditors only issue statements at the end of the month, it will not be possible to check any corrections and additions that should have been made by the creditor immediately, and therefore another process must be followed. So it's not as easy for us to make corrections in their books, for instance, as it is for us to make corrections in our own books. So the business will have to record transactions that have already been entered into their records and which have already increased or decreased the balance in the creditor's accounts, but which have not yet been recorded on the creditor statement, or errors that might have occurred on the statement in such a way that it can be checked when they receive the statement from the creditor at the end of the following month. So we're going to keep record of any errors or omissions again on a statement, and that statement we are going to call a Creditors Reconciliation Statement. So Creditors Reconciliation Statement consists of all invoices, checks or debit notes which have already been recorded as an increase or decrease on their balances for the creditor in our ledger account, but which have not yet been recorded in the creditor's records. So in other words, it's something that appears in our books, but it does not appear on the creditor's statement yet, or any errors that the creditor might have made. So the creditor's reconciliation statement must be compared with the statement received at the end of the following month in order to check if the necessary entries for the increases or decreases which has not been depicted on the last statement have been done so on the new statement. So we will check in the following creditor statement whether the reconciliation done in the previous month was actually updated or not. So therefore we are going to have to wait a whole month before we can actually see whether these corrections were made by the relative creditor. So if I can show you quickly a creditor's reconciliation statement, remember, very important, from a creditor's reconciliation statement's point of view, we are making these changes or updates as if we are making them for our creditor. Now just remember, in our creditor's books, we are an asset, which means that the debit side increases and the credit column decreases. So you can see here, as soon as it's a debit balance as per bank account, it will be on the debit side. Then any checks or payments made, discounts, checks, or any credit notes will all go into the credit column. In other words, the decreasing column for the creditor's statement. If, however, there were errors made through invoices or something to increase the account, this will be done on the debit side of the account. So all of these, the first lines in my statement, all has to do with the creditor's statement update. So this is as if I'm updating the records of my creditor. Then I would always go and add in the last line, and that is a credit balance as per creditor's ledger, and that comes from my own records. So therefore the above lines are all for the creditor's records, and then we put our own records in as well. And then if I add up the debit and I add up the credit, it should balance out on the same amount. If it balances on the same amount, then I know that I have reconciled my books to that of the creditor, and therefore I know that I am in balance with them, even though some of their transactions have not yet been recorded.